Hey everyone, happy Friday. I'm Phil Hodgen and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. Listen in online or watch the show later on YouTube. We post it when we get the recording. And this month, the topic is episode 7 in the 5471 series. And this month, we're talking about distributions from controlled foreign corporations and how those hit the income tax return of a U.S. shareholder. And here's how it's going to work. If you have questions, throw them in the chat field. Rachel in my firm is in there. She will be collecting questions. I'm not going to answer them this cycle, but at 1 o'clock, we're opening up a separate Zoom room on our account because Cal CPA doesn't want Michael to be sitting around forever just watching the clock. And I'll be there and I'll answer questions and, either live or in chat or whatever. So you'll have the opportunity to ask those questions then. And in between this session here and the session at 1 o'clock when I'm live there answering questions, we have time for caffeine and potty break. Well, let's get going. This is episode 7, as I said, of the 5471 series, and you're going to see me looking here because that's where the screen is, and instead of there, where's down. Anyway, we'll get the webcam in the right place next month. This is the series, and this is where we are so far. So we've already gone through the question of how do you figure out if you have a taxpayer who is a client, who is a filer of Form 5471 and what category and all that stuff. This is the third in the 3 episodes about income that will come out of a controlled foreign corporation to a U.S. shareholder. And so first we did the make pretend income. Let's pretend that you earned the income of this controlled foreign corporation and you're a shareholder, as Subpart F income, as global intangible low taxed income. And now this month is real cash distributions, well, cash and property. But for simplicity, I'm going to be talking about just cash distributions from a CFC. And then starting next month, we're going to do the damage control, say, oh, poop-a-doodle, I've got a bunch of income that is really not so welcome. What can I do to mitigate the damage? We'll talk foreign tax credit, fixing your structure, making the Section 962 election, and then wrap up with next March with sort of comparing CFCs versus what else you got if I want to run a business overseas. So that's where we're going with this thing. Table of contents, we're going to talk about why there's a problem. There are 2 solutions that we're going to talk about today. So we're really not going to talk about money. We're going to be talking about the plugs in the holes that that Congress has put in the Internal Revenue Code, a gross income exclusion and a dividend received deduction. And then I'm going to walk you through a quickie example. So first, let's see, why do we even have a problem here? Why are we concerned about distributions coming out of a CFC to a shareholder who happens to be a U.S. taxpayer? Isn't that kind of normal? Let's start first with the distinction between 2 words that are kind of used interchangeably, and yeah, I do the same thing. Distribution versus a dividend. Distribution is when money or property comes out to a shareholder from a corporation because that person is a shareholder. So the legal relationship between the shareholder and the corporation is the ownership of shares. And distribution means money or property flows because of that legal relationship, unlike a loan, or I'm an employee of my own corporation, or I'm charging my corporation rent, or whatever. Those are different legal relationships. So we're strictly talking about because my name is on the share certificate, I'm getting stuff. A dividend is not the same thing. It's a subset of distributions. A dividend is when you look at the paying corporation and the money that you are getting in this distribution can be traced back to the distributing corporation's earnings and profits. So again, a dividend is a distribution that comes out of the distributing corporation's earnings and profits. A lot of times when I'm in a rush, I use dividend when I should use distribution. I'll try to be as clean as possible, but just bear in mind that these mean two very different things, because a distribution can be tax-free or it can be taxable depending on the context. So why does a double taxation problem happen in the context of a US shareholder owning a CFC? And for simplicity, in this little game today that we're playing, think about US citizen human being owns 100% of the stock of a Delaware C Corp, owns 100% of the stock of some CFC somewhere. So that's the sort of a very classic generic kind of holding structure. Why is there a double taxation problem? It's because the government has decided to use or abuse subchapter C depending on the outcome they want. So the first thing that happens is subchapter C principles are violated. Subchapter C is the section of the code that says this is how corporations and their shareholders are going to be taxed. And the general principle is a corporation is its own thing. It pays its own tax on its own income. And the shareholder has income only if and when there is a dividend distribution upstream. So a distribution from earnings and profits to the shareholder, and that's what causes the shareholder level income tax liability in the form of dividend income. So because shareholders were clever, they did things with foreign corporations the government didn't want. Hence, the government created this concept, subpart F income, in 1962, which said, we don't care about subchapter C and its niceties. We are going to tax you, dear shareholder, on the CFC's subpart F income, whether it's distributed to you or not. And so that's section 951, open parentheses, little a, close parentheses. And then in 2017, the government said, you know what? There's this whole other bucket of CFC operating income that is not currently passed upstream to the US shareholder, but we think it should be. And that is section 951 cap A, which is our friend global intangible low taxed income. They both operate roughly the same way for our purposes. It's only in the computation details that we have some differences. So the first thing that said, we are no longer going to consider the corporation as its own encapsulated little being. We're going to selectively leak out its income upstream to US shareholders. On the other hand, the way that the rules for CFCs are written, it says, no, we're going to absolutely respect the rules for dividend treatment. A dividend is a distribution from earnings and profits of a corporation. And that principle still stands, even with the controlled foreign corporation. So you see, we want some of what subchapter C has to give, and we don't want other parts. And we're trying to optimize for some political or economic result. And that's what Congress did with the international tax rules applicable to CFCs. They solved it in the same way. They respect subchapter C rules in some way, and they reject subchapter C rules in other ways. So how do they solve it? It's an interesting thing because you see the evolution of tax policy philosophy from 1962, when the subpart F rules came into play, to 2017, when the global intangible low tax income rules came into play. So in 1962, they said, here's our game. If you get a dividend, quotes, distribution from earnings and profits from a CFC, it's not a dividend. And if you look at Internal Revenue Code section 959D, it basically says that in so many words. This ain't a dividend. Okay, so therefore you don't bring it into income as dividend income for the shareholder. So it's an explicit override of section 316, which defines what a dividend is. That only applies to previously taxed earnings and profits. So subpart F income that was included in the shareholders' income, sideways through Section 951, or global intangible low taxed income, which is added to the shareholders' gross income for tax purposes via Internal Revenue Code Section 951 Cap A. So that's the old rule. Previously taxed earnings and profits, it's not a dividend. We don't include it in income, go away. And I'll show you mechanically how that works in a little bit. The 2017 version of how things should work is wildly different. In this case, it applies only to untaxed earnings and profits. In other words, it's not Subpart F income. It's not global intangible low tax income. It's just untaxed earnings and profits inside the CFC. And I'll show you where this is that you're usually going to find this. It's in the computation of how much global intangible low taxed income do you have out of this CFC anyway. And in that case, the dividend rules of subchapter C are respected, and it's a dividend. But what they do to mitigate the damage is they give you a 100% dividend received deduction, which means that you bring in $4,000 of a dividend income from the CFC when cash is distributed to the shareholder. You get immediate $4,000 dividend received deduction. Net effect on your income tax bill is zero. Same result. Now, just as an aside, why did they do it the old way, gross income exclusion in 1962, and the new way, dividend received deduction in 2017? If you go and you read the preamble to all the crap that they did in 2017, the legislative history, that's what preamble crap means. Legislative history, the Senate Finance Committee and the Joint Committee on Taxation write these. This is why we did what we did. And they say flat out, we tried every conceivable way we could, but we found that the way we had to deal with the global intangible low tax income was just the least bad way administratively for us and for the taxpayer. So they learned something over the 60 years from 1962 until now, right? So good for them. So that's what we have. We have cash money coming in as a dividend. The default assumption is when you get a dividend from a corporation that you're a shareholder of, it's going to be dividend income to you. And we have two different tools that CFCs, well, I should say US shareholders of CFCs use to neutralize the impact on their taxable income down to zero. And so let's start now with the first one, which is the gross income exclusion, which is in Section 959. And this comes from the 1962 Foreign Tax Act. And specifically, remember that this is for previously taxed earnings and profits. So let's look at it. Who and what? Because this is different again for the dividend received deduction. So who can use this? All US shareholders of all types. So a human, a C Corp. I'm going to be talking about a C Corp US shareholder today, but a human gets the Section 959 exclusion as well. And what does it apply to? Previously taxed earnings and profits. So this is earnings and profits of the CFC that have been passed upstream and included in the gross income of the US shareholder. A quick aside, there are a lot of things that puzzled me for a long time, but this one I finally figured out. Let's say that you earn $10,000. CFC has $10,000 of E&P, current E&P this year, and it makes a $10,000 distribution, cash upstream to US shareholder. So cash in and out. The sequence is, and how do you know, did that distribution come from untaxed earnings and profits or previously taxed? And the sequence is, the way you do it is you compute E&P first at the CFC level. Second, you do the gross income inclusion for Subpart F income or global intangible low taxed income for the current year. And then third, you say, okay, that's already been included, even though it's a sort of momentarily and metaphysically, a nanosecond before we made the cash distribution. And then third is the cash distribution. So we always put the distribution in sequence last after the inclusion in the current year. I mean, obviously, if you're going to earn income in one fiscal year for the CFC and you're making the cash distribution the next, easy peasy. But until I embedded that thought, this is the sequence, distribution last, that was sort of opened it up for me. So here's section 959, and slight incursion, excursion, I should say here. Look at this. Doesn't it make your eyes bleed? I mean, I'm a tax lawyer. I went to law school. I do this for a living and I read all this stuff. And it's hard. How do you even pick out what does this mean and what am I supposed to do with it? I'm just showing you in the next couple of minutes my methodology for taking a big block of prose like this from the Internal Revenue Code or from the regs and how I boil it down to what does this even mean? So what I do is I will go and I'll take the code section and I'll paste it into a Word file. And then the next step is I will go through and I will delete all of the superfluous stuff. So the superfluous stuff will be, like the title of the subsection. And then all of the wordy words, for purposes of this chapter and things like that. And you'll see down in the bottom full paragraph, the flush left text, see there's a parenthetical that applies to when a U.S. shareholder transfers stock to another U.S. person, well, who gets the exclusion? We're not playing with that game, so I can delete all of that. So in other words, I try to clean out all the stuff that doesn't matter, weed the garden. And so I can look at just the words that are important to me. And then what I do is I replace those deletions with ellipses, the three dots. And if you look at a code section, the Internal Revenue Code is basically, you're either looking at a definition, a corporation is this, a United States person is that, or you are looking at an if-then statement. And so this is an if-then statement. If earnings and profits have been attributable to amounts which have been included in gross income of a United States shareholder, section 951A or 951 cap A, then it shall not again be included in the gross income of such United States shareholder. Now it's simple. So this is just, you'll find your own way of trying to read the code and understand what it says. And reading the code and understanding what it says is not a matter, I mean, it takes some base level of intelligence, but it's not a intelligence problem as much as it is a skills problem. And trust me, you can get good at this. So find your own method, adopt mine, play with it, do what you want. Quite often you'll find that a code section is written upside down. It'll say the then function first and then the if at the bottom. An example of that would be if 959A said, do not include this stuff in gross income again if the earnings and profits have already been included. All right. So I will, if I have a code section like that, I will reverse it because I want the classic if-then syllogism. So end of little story. Incidentally, there's another one that I think there's a skill that you can learn. There's a rev proc for dormant CFCs, rev proc 9270. So 1992, right? What could happen since then? Well, they could change a bunch of laws. And if you read rev proc 9270 because you want to do the abbreviated 5471 filing for a CFC, you read it and you look at all the references to regs and code sections in there, you will find one of those code section references. You go look at that code section and there's nothing there. If I remember right, it was something like it refers to section 6038A3. So you pull up section 6038 on your handy computer and there is no A3. It goes A1, A2, something like that. Now, at that point, you have the rev proc that you're trying to follow and do right so you can file and this abbreviated form 5471. But you've got one of the conditionals in that resolving to nothing, right? Error. Is this important or is it not? And a lot of times people will just skip over that stuff. It'll be fine, or maybe not. There is an easy method, or not easy. Yeah, it is easy. It's just tedious, where you can follow through the change in section 36, 6038 in my example, and you can find out when did they change it? What did they change it to? And does this matter to, and then you can make the decision, does this matter to me? And in the case of this RevProc I'm telling you about, what happened was they just moved, again, for example, I'm not saying this is it, section 6038A3 into another place. And so it's still there. And now you just know that they were too lazy to update the RevProc, but you know that you can decide whether the RevProc applies to you. So my commendation to you is reading the law is a skill. You can get good at that. If you passed one of the exams, and I know you did because you're here, you've got the brain power to do it. It's just tedium and reps. End of that. Okay, so we had section 959A that says none of this stuff is included in gross income, just flat. And then, belt and suspenders in 959D, they say this distribution is not a dividend. Okay, so just to reinforce the treatment of this distribution, it's excluded from gross income, which you would think would include dividends because dividends are gross income. But they're saying specifically don't characterize this distribution as a dividend. And what this is going to do, it looks like redundancy, but it's actually subtly important. And I'll show you in a second why. It goes back to the subchapter C rules and how we are monkeying with it and overlaying some overriding principles. So the basic thing is first you look at a definition of what's a dividend, right? So the code is full of dividend rules and if-then statements. Dividends are distributions from earnings and profits. Okay, then you go over to section 301C and it says when a shareholder gets a distribution from a corporation, any corporation, first treat as a dividend to the extent it's from earnings and profits, duh. Then, if it's not one of them, then you go down to C2, which says, it's a return of capital reducing basis to zero, and C3, which says it's capital gain above that. So in a table, I want to show you because this, again, took me a long time to fully understand how all of the puzzle pieces fit together, and I want to share with you how gleeful and happy I am that I finally understand it. So on the left column, the default rule for distributions is 301C. You start first, it's a dividend down. If it's not a dividend, it's a return of capital and it reduces basis until you hit zero. And then finally, once you've hit basis equals zero, further distributions are capital gain. The overriding rules are in this pink, lovely pink color. The first rule is 959D. It's not a dividend. The end. Shut up. All right. And then we look at the bottom and saying, well, would this distribution be capital gain? Well, capital gain is gross income, right? So it can't be that. And so we can say 301C3 does not apply, which means the last man standing is this middle one, 301C2, which is the only plausible way that we can understand how the tax system wants you to get cash out of a CFC, put it into the shareholder's pocket, and have it a non-event for tax purposes. And what they do, so the answer is here. And how they do it is the far right column. You have an allocation of income by the phony baloney rules of subpart F or global intangible low tax income. There's a companion increase in basis for that. So I have $10,000 of subpart F income from this CFC. I get a $10,000 increase in the basis of my stock of the CFC. Step two, I receive a distribution of $10,000 from my CFC. I apply the normal subchapter C rule of section 301C2, and it says, take the money in, reduce your basis to zero. So I had a plus 10,000 on basis, and now I have a minus 10,000 on basis. Net offset equals no tax, right? And furthermore, I have not reduced my basis where later if I sell the stock, I'm going to have capital gain. So everything comes out easy peasy. So that's how it all works. We've got three code sections, four if you count section 316 for the definition of a dividend, 301C, 959, and 961 all work together to conceptually get a dollar of cash out of a CFC where the earnings and profits have been taxed already and put it in the hands of the shareholder without any tax impact. And so, and foreshadowing my little example, what we've just done is the code has made a little book tax difference that you're going to have to resolve on either Schedule M1 or Schedule M3 on the 1120. So here, just one more time, how it works. A dividend, we have a subsidiary and it's got 10,000 of earnings and profits, and I'm using subpart F income just because it's a simpler example. Dividend comes upstream out of earnings and profits. We would expect ordinarily the parent company to have $10,000 of dividend income. But this override that I've been talking about, we have the $10,000 of dividend income. Well, actually, before that, here's the double taxation problem in play. We have $10,000 dividend income and we have 10,000 of subpart F income. And this is the problem where you've got $20,000 of taxable income on the parent company's Form 1120, but you've only got $10,000 of real earnings down to the subsidiary level. So something's got to give. And this is what happens again, one more time. Section 959 says that $10,000 dividend is excluded from income, which leaves only the subpart F income that goes upstream to the parent company's income tax return. The cash itself does not create taxable income at the subpart F level. So that's the picture, sort of like three different ways: the word cell way, the table way, and the little stick diagrams way. I hope one of them works for you. And again, here I'm just picking Schedule M3 because it has a line for it. This is where gross foreign distributions previously taxed. See, they used the word distributions correctly. They didn't specify dividend. They were, and you enter your book tax difference there, and hey presto, you're done. Okay, so that's the default situation where you have a 959 exclusion. And if you have a human being, the same thing, the section 959 exclusion works, and it's going to keep the dividend out of income for gross income tax purposes on the 1040. Let's move now to a situation where you have a human shareholder of a CFC, and you're looking at the section 962 election as a way to minimize the collateral damage of subpart F income or global intangible low tax income. So section 962 in a nutshell says, if you're a human and you're a US shareholder of a CFC, you can elect to have that pass-through income, the subpart F income and global intangible low tax income, taxed as if you are a corporation, a C corporation. What that means is you get a corporate tax rate, 21%. It also means that there's a special handy dandy, here you go, here's a free cookie deduction in section 250 that says 50% of the global intangible low taxed income, you get a tax deduction for it. So if you get $1,000 of global intangible low taxed income passed upstream to you by section 951 cap A, you get a $500 deduction. So your net taxable global intangible low tax income is $500, cutting your tax bill in half. And the final good thing about the section 962 election is that you have the ability to claim the indirect foreign tax credit. So this is when the CFC as a C Corp pays some foreign income tax, and you are allowed as the shareholder to claim a foreign tax credit for it. Because the basic rule for foreign tax credit is you got to be the person that paid the foreign tax in order to claim the credit. And here, someone else, namely the CFC, paid the tax. And we'll talk about foreign tax credit next month. Foreshadowing. So, and there's a significant disadvantage, and this is the disadvantage is what we're going to talk about right now. Right. You see that Internal Revenue Code section 959, the gross income exclusion, applies dollar for dollar. So every dollar of previously taxed earnings and profits, you shoot cash upstream to the shareholder. That cash is excluded from gross income as a dividend. If you make the section 962 election, section 959 is not applicable, and instead you have a special rule in section 962D. And the amount of the exclusion there is the actual income tax paid on the inclusions, not the amounts of earnings and profits at the C Corp, at the CFC level. So it's going to be a much, much smaller number. And the rest of the distribution is going to be included in your gross income as a dividend income. It will either be taxed as an ordinary income, ordinary dividend, or a qualified dividend, depending on where the corporation is and can qualify as a qualified dividend from a foreign corporation. So here's section 962D, and I haven't gone through the editing process with it, but I want to highlight this part is this phrase, notwithstanding the provisions of section 951A1. So that's the gross income exclusion. So that says 959 is off the table. And then this other little phrase that I've bolded here, it says the amount to be included in gross income is the distribution minus the amount of tax paid under this chapter, meaning the income tax rules, on the amounts to which the such election applied. So meaning you bring your subpart F income or global intangible low taxed income up onto the Form 1040. You compute the amount of income tax paid on those inclusions. You then look at the distribution, see, paid upstream to the shareholder. You subtract the amount of income tax paid on those inclusions, and the subtraction is tax-free to you, and the rest of it is dividend income because it's coming out of earnings and profits. So here's my little example. Again, we've got subpart F income, $10,000. We have tax rate at 21%. Remember, we have the corporate tax rate because this is an election under section 962. So you use the corporate tax rate. So the income tax liability for the human is $2,100 on this gross income inclusion. Happy days. Now we look at the $10,000 cash distributed upstream to the human shareholder. What's the gross income exclusion? Well, it's the $2,100 of actual income tax paid. And that means that the dividend component of that $10,000 cash distribution is $7,900. And I'll leave it to your own imagination to consider what's the tax cost on that 7,900 if it's taxed as a qualified dividend or as taxed as ordinary income. So net, if you just look at the distribution stuff, section 962 doesn't look so good. But there are a lot of contexts in which section 962 elections work out fine economically. And again, foreshadowing the future, there's a whole hour on section 962 elections coming at you in a few months. All right. Final weird thing about gross income exclusion. It applies only to income tax. It does not apply to the net investment income tax. And the reason is kind of subtle, but once you see it, you see it. All of the income tax rules are in Chapter 1. All of the net investment income tax rules are in Chapter 2, Cap A. And so this is one of these situations where when you get really good at parsing the phraseology in a code section, you say, notwithstanding any rule to the contrary in this chapter, and you're in chapter 1, it has no impact on what's going on in chapter 2A. So it'll stand completely alone. And when you look at it and you look at what's the definition of net investment income, because that's the income base on which the net investment income tax is computed, then the definition of net investment income does not include an analogous provision comparable to Section 959. So what you're going to have is you're going to have, let's say, your hypothetical $10,000 cash distribution upstream, and some of it's going to be excluded because of Section 962D. Remember, in my little example, $2,100 was excluded. And so you have, for income tax purposes, you have a dividend of $7,900. But for net investment income tax, our friend, Mr. 3.8%, thank you very much, you'll have a $10,000 dividend income. So that's the gross income exclusion rules. They're a little bit more cumbersome, but once you get it, you get it. But conceptually, it's a little, in my opinion, a little bit more difficult. And so we are going to now transition to the other exclusion that we're going to use. And it's not an exclusion this time, it's a deduction, but it has the same effect of making sure that our C Corp US shareholder doesn't pay any tax. And this is a much simpler in concept and practice rule to apply. So whatever the intention was when everybody, all the brainiacs in DC put their thinking caps on and figured out how they're going to make this work, they picked an evidently and actually administratively simpler way to ensure that they get the result they want by way of this dividend received deduction. And there are other dividend received deductions in the code, and I know you know about them. This is just a new one that applies specifically in this context. So the who and the what. Who can use this? Domestic C corporations, and who they have to be United States shareholders, which means they have 10% or more of the stock of a foreign corporation, of a specified 10% foreign corporation. And a specified 10% foreign corporation happens to be a foreign corporation that has a domestic C corp that owns 10% or more of the stock. So it doesn't have to be a CFC. It can be, a domestic C corp owns 10% of the stock, and random third-party non-resident alien owns the other 90%. The 245 Cap A still applies. And what does it apply to? Remember that the gross income exclusion of Section 959 applies to previously taxed earnings and profits of the CFC. The dividend received exclusion mops up the rest of the earnings and profits in the CFC, namely the earnings and profits that were not included in the gross income of the U.S. shareholder by being Subpart F income or by being global intangible low taxed income. So we've got full coverage in theory. Maybe there's a hole that I don't know about yet, but we have full coverage. So a CFC's earnings and profits can only be previously untaxed or previously taxed to the U.S. shareholder. And the exclusion of 959 applies to the previously taxed. The dividend received deduction applies for U.S. domestic C corps to the untaxed earnings and profits. And again, here's the if then. I've broken it down so I can see it and understand it because my brain likes if then statements. So in the case of any dividend received from specified 10% owned foreign corporation by a domestic corporation, which is a United States shareholder with respect to such foreign corporation, there shall be allowed as a deduction an amount equal to the foreign source portion of that dividend. So, important part for us to focus on is that foreign source portion thing. But there's the simple rule. Domestic corporation, which means a C corporation, which is this whole little byway and garden path discussion for why the words domestic corporation mean a C corporation only and not other things. But anyway, so this is the dividend deduction, dividend received deduction that we're going to be playing with. And here's where it shows up on Schedule C of Form 1120. You see in the far right-hand column, the little red box, that's where your deduction is going to go. And if you look, I mean, the left, I mean, I know you've seen Schedule C a million times, how everything totals down at the bottom on lines 23 for income side and line 24 for deduction side. You port those numbers over to Form 1120 on page 1. Hey, presto, do some math and you've computed a tax liability. A quick comparison here. The Section 245 Cap A dividend received deduction that we're talking about is highlighted in this beautiful turquoisey color. And it applies, important, to foreign source earnings and profits. So let's compare it quickly to 243 and 245, which are probably the dividend received deduction rules that you see more frequently, particularly if you have a lot of domestic practice going on. The first one, 243E. If you look at the rest of 243, it talks about dividends from domestic corporations. 243E specifies a situation when a foreign corporation's dividend to a domestic C Corp will be covered by the 243 dividend received deduction. And that's when you had a domestic corporation, it morphed itself into a foreign corporation, but it had some carryover E&P from its domestic corporation days. So really an edge case, but it's there. 245 is the more common one. It's kind of the mirror image of 245 Cap A. So 245 says if a foreign corporation has U.S. source earnings and profits, you get a dividend received deduction for the domestic C corporation under that. And 245 Cap A is, well, it's foreign source income, foreign source earnings and profits. You get the dividend received deduction for that. So the world is divided into the United States and not the United States. And so earnings and profits from foreign corporation upstream will be potentially covered by one or the other of these things. So that's how it all fits in. And I put Section 250 in there just because it's not the same, but it kind of rhymes and it's in the same neighborhood. This isn't a dividend received deduction. It's that offsetting deduction against global intangible low taxed income that they gave us in 2017. 50% of the inclusion amount is allowed just as an automatic deduction. I mean, and that slowly ratchets its way down. It goes down, I think, for tax years starting in 2025, the percentage drops from 50% to something. And it'll eventually go away because it's a lot easier for Congress to take away a deduction. And everybody squeals and they go on with their day. All right, finally, let's wrap up with an example. We're going to march through some tax forms, and I'm going to show you exactly how some simple numbers flow through from Schedule 5471. Form 5471, Schedule I-1 for global intangible low tax income, all the way through to Schedule C on the 1120. So here's my simple example. We've got $10,000 of gross income and zero expenses. And yeah, I know I've got $40,000 depreciable assets on the book, and I'm not claiming any depreciation deductions, but sue me. It just makes the example a lot simpler and a lot fewer numbers to put on a page. So everything is handwritten in this thing. Thank you, iPad. So Schedule 5471, Schedule I1, this is where we start. And just as a philosophical matter, when learning Form 5471, it's my opinion that you start with the most important thing, which is the income flows through, and everything around the income items either informs the income item itself and how it's computed and passed through, or it relates to it, like an offset for foreign tax credit or things like that. But this is the core, and you start here and you can add, if you start here and you get your knowledge real good on 5471 on the income, Schedule I and Schedule I1, everything else will follow. Anyway, we got gross income of 10 grand. We don't have any effectively connected income. We don't have any of that on line 2. We have, go down to line 6, we have this number $10,000, which is tested income, which is a defined jargony term for global intangible low taxed income. And we have the math that I just made up. We've got a bunch of depreciable assets on the balance sheet of the corporation, and the depreciable basis is 40,000. And the global intangible low taxed income rules have a fancy way of computing that number. You'd compute it quarterly, take an average, and blah, blah, blah. Ignore all that because it doesn't matter for this example. You're going to take the Form 5471 I1 goes over to Schedule A of Form 8992. And Schedule A is sort of the collecting tank for all of the Schedule I1s that you have for all of the CFCs in which you own stock, and it aggregates all the numbers, pluses and minuses together. See, we have column E says tested income, column F says tested loss. So what if a CFC had a loss? Anyway, we're totaling everything up here. In my example, we only have one corporation, so it doesn't really matter, but we need to fill it in because when we go to Form 8992, it's going to suck some numbers off of Schedule A and tell you to put them onto Form 8992 so you can compute how much global intangible low taxed income is going to hit the shareholders' income tax return. So we go through the drill anyway. And here we go. This is the bottom part of Form 8992, where we calculate how much global intangible low taxed income this particular CFC has. So we start with tested income, which comes from, ultimately Schedule I1. But it's also repeated in part 1 of Form 8992. And then line 2, this is, you pluck the $40,000 of qualified business asset investment off of the Schedule A of Form 8992, multiply by 10%, and you have line 2. And this is really all you need for the simple math of computing global intangible low taxed income. All the hard math is hidden away from you, for instance, in computing that 40,000 number that I just sort of hand waved into existence. So you go down this line and you'll see that my line 2 minus a bunch of stuff which is 0, equals line 4. And this is my net deemed tangible income return. So Congress has decided that when you have hard assets, a rational investor would want a 10% return on investment for those hard assets, and therefore you should be happy to get it. And that's how much we're going to pretend that we're going to allocate from the CFC's income for return on the hard assets, and everything else is on line 5, global intangible low tax income, which is generated by all of the other activities of this CFC. And the government thinks this is bad income because it's movable income, and you could reconfigure your business to have that income earned in Hong Kong or Burkina Faso or Great Britain or any Brazil or whatever you wanted to for tax reasons, and that's bad, and therefore we are going to not let you do that. So pretty simple. Once you've got your numbers, tested income and the qualified business asset investment, QBAI, to figure out how much is global intangible low taxed income and how much is not. And foreshadowing the obvious, global intangible low tax income, we all know, is included in the gross income of the shareholder. Therefore, it's been going to become previously taxed earnings and profits. And we know that if we had 10,000 of E&P and we included 6,000 in previously taxed, that must mean there's 4,000 of untaxed earnings and profits. And so now you can see how much money is going to be protected from tax on the 1120 for the U.S. shareholder, 6,000 by Section 959, and how much is going to be protected from taxation on the shareholders Form 1120, untaxed E&P by the dividend received deduction of 245 Cap A, 4,000, and that's how it's all going to come out. I'm adding all of the forms in sequence just for drill. So we've got $10,000 of current income, blah, 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 ends up with $10,000 of current E&P. No magic. You take your current E&P to one of these, more and more we're getting these schedules that have, it's like a giant spreadsheet on two pieces of paper, and it's what a pain in the ass they are. But I'm not bitter. And you bring the current E&P, you add it to last year's accumulated E&P, and you come down to line 7, which is total current and accumulated E&P so far. And then what do you do with it in order to get your E&P adjustment to come down to the year-end E&P that you're going to carry on to the next calendar year, fiscal year. And you see line 8, we have a reclassification. So that's code word for 6,000 of my E&P is previously taxed. So I'm going to put a minus number in column A, which is the untaxed earnings and profits. And I'm going to port it over to column E something, where I'm going to put a plus 6,000 and to show that I've got 6,000 of previously taxed earnings and profits. And then line 9 is actual distributions. And see how the sequence of the law is reflected in the way they design the form. First, you reclassify untaxed E&P to previously taxed E&P, and then you make the distribution. So column 9, row 9 in column A, this is the $4,000 distribution. Remember, we're assuming we'd made a $10,000 dividend distribution to the shareholder in the current year. 4,000 of that came out of current E&P because it was untaxed, because it was the net deemed tangible income return. Man, the acronyms are hard. I have to think them through in order to get them straight. And at the end of the year, we had 10,000 of E&P earned in the current year, and we ended the year with no untaxed E&P because we did a distribution. And here's the far right-hand side of the second page. You can see on line 8 how I moved the positive E&P over to previously taxed Section 951 Cap A in previously taxed earnings and profits. And then line 9 shows the distribution of those profits to the shareholder. And then line F is just the total column. I mean, column F is just the totals. So that's how the whole E&P thing flows together. And again, going back, I think I put it in the newsletter this morning. The way I learned all of this stuff was by doing exactly what you see here, by printing out forms, grabbing a pencil and an eraser, and slowly learning how numbers moved by comparing the code section to the form. And that's how I really start to learn this stuff. Schedule P is the shareholders. Schedule J is the whole corporation. Schedule P is the shareholders accumulated E&P. And it mirrors everything in column E pro rata. Column E is in Schedule J is for the whole corporation. This is the pro rata portion allocable to the shareholder. Since the shareholder has 100%, the numbers are the same. But again, just for drill. And you can see the titles of the columns are the same as Schedule J titles. So Schedule R is where finally the rubber meets the road. This is where the Form 5471 says to the Internal Revenue Service, this is the distribution we made this year to shareholders. And this is what it likes and what it's like. I am convinced that Schedule R is going to go through a bunch of iterations. Right now, it's very basic, and you have to fill in, what you're doing line by line, and you can see the example. And they want a little verbose, or you can shorten as much as you can make it so it's legible. But they want you to give a little description in column A of what this distribution is, and they want to be able to flag, is this previously taxed E&P, or is this untaxed E&P? Is it excluded under 959? Is it eligible for a 245? Oops, I missed the cap A on the other part. So anyway, you free form creativity, you put something there, but you can see that the numbers add up to the 10,000. It's all in functional currency, and it sort of reconciles the E&P. And this is where you end up. And then magically numbers go on to Schedule C. So line 13, see the $4,000. This is the distribution again from untaxed E&P. So it's a dividend. That's the left column. But we get the 100% dividend received deduction, which is the right column. Line 17 is the global intangible low taxed income inclusion that we got from Form 8992. And so that goes on Schedule C on line 17. And then we're going to add it all together. And we have special deductions and total income, total deductions. You will note for the clever people, line 22, there is no Section 250 deduction claimed. That's a 50% of the 6,000 global intangible low tax income. I didn't do that. I'm trying to leave as much stuff off this, so what I want to talk about is visible and distractions are not visible. Yet I know a lot of times, people who have done this before say, wait, you forgot this, and they're distracted by the absence. So there it is. I know it's absent. Reconciliation, I just use M3 because there's a handy dandy little line there to show the reconciliation between book and taxable income. And there we have it. So this is how the game works for distributions. You're going to be playing in Section 959 land for previously taxed earnings and profits of the CFC. You're going to be playing, at least for C corporations, with the dividend received deduction under Section 245 Cap A. And as usual, it's always in the boring accounting stuff and tracking E&P and doing all of that stuff that you have all your glory. We're at 58 minutes. We're going to take a couple minutes break. Thanks for being here. And we'll reconvene at the top of the hour in the other Zoom room, and I'll be answering questions there. But just as an outro here, shoot me emails, ask questions in the Zoom room after. The next session is going to be a little bit less than a month. We're changing the schedule so it doesn't collide with Thanksgiving. And it's going to be on November 17, again, noon Pacific time. And at that point, we will be off daylight savings. So watch your time, the time shift. And it will be on foreign tax credit. If you're not on the mailing list already, go to hodgen.com, find a place to sign up for the mailing list, and off we'll go.